Are you stressed about back taxes? I've got good news. I'm going to give you 3 ways you can actually get IRS back taxes forgiven, and I'm going to show you exactly how. By the end of this video, you'll understand 3 proven methods to reduce or eliminate your debt, potentially saving you thousands. I've helped clients with massive IRS debts cut their liabilities down using these exact methods, and I'll explain how you can do the same. By the way, I'm Brad Paladini with Paladini Law. I'm a tax attorney who has helped hundreds of clients navigate the IRS and settle back taxes, preventing them from losing everything. Over the years, I've negotiated tax settlements that have saved clients millions of dollars. One of these methods could cut your tax debt by up to 99%, and I'm going to explain how to do that in just a moment. Stay with me. The first way to reduce your tax debt is through a partial pay installment agreement. So a partial pay installment agreement is exactly what it sounds like. This is an agreement where you pay the IRS a certain amount per month, but the total amount paid over time is less than the full tax liability. Why is this? Well, the IRS only has 10 years to collect the tax debt from you. So if you owe the IRS several hundred thousands of dollars and you agree to pay them $100 a month, obviously they're not going to collect the entire debt within that 10-year period. And so the IRS calls this a partial pay installment agreement, where you agree to pay them what you can afford right now, and at the end of the 10 years, the rest of the debt is waived. And you probably haven't heard about this strategy elsewhere because it's not used nearly often enough, but it is something that we successfully use with clients who would just never be able to fully repay the debt within the 10-year period, and the other options that we discuss wasn't suitable for them. Now, you might be thinking, what if I can't pay anything at all? I owe several thousands of dollars, tens of thousands, hundreds of thousands of dollars. I can't even afford to pay a couple $100 a month. Well, there's something else called currently non-collectible status. Currently non-collectible status, the way I like to think about it, is it's a payment plan for $0 a month, right? So the IRS will look at your income, they'll look at your reasonable expenses, right? So they know you have to pay for food, you have to pay for your housing, you have medical bills, maybe even you have a car payment, and they will allow you to pay for all of that. And maybe after you do, there's simply nothing left over for the IRS. In that case, they will put you on what's called currently non-collectible status. Now, the good thing with currently non-collectible status is that the statute of limitations continues to run, just like it would if you're on a payment plan. So if you can stay on currently non-collectible status for the full 10 years, you'll have to pay a dime and the entire tax debt will eventually get forgiven. The second strategy I want to talk about is a penalty abatement. So this is where the IRS agrees to waive penalties that have accrued on the tax liability. And the 2 most common types of penalties that we see at our office are the failure to file penalty, because you didn't file your tax return on time, and the failure to pay penalty, because you didn't pay your taxes on time. Now, there's 2 different ways that you can apply for this relief. One is sort of administrative. It's a first-time penalty abatement. So the way this works is if you have a large tax penalty for, let's say, the 2022 tax year, the IRS is going to take a look at your situation for 2021, 2020, and 2019. And if they see that you have a good compliance history just for those 3 years, and a good compliance history means that you filed your tax return on time and you paid your taxes on time, they will waive the penalties for 2022, no questions asked. So recently we had a case where someone incurred a very large penalty for the tax year 2021. It was about $80,000 in penalties for not filing the return on time and not paying the return on time. And this case was pretty interesting because we talked a moment ago about the 3-year compliance history. So this was a 2021 abatement. She needed to show that in 2020, 2019, and 2018, she filed the return on time and paid the return on time. In this case, for the 2018 tax year, she actually incurred a very small failure to pay penalty. What had happened was she filed the return, she paid the tax timely, but then a few months later, she realized that she had made a mistake. And so she amended the return and paid additional taxes with the amendment. Now, since this payment was late because the filing deadline had already passed, or the payment deadline had already passed, she incurred a failure to pay penalty. And it was really small. It was less than $100. So even though she didn't technically qualify for this first time abatement, we argued that the incentive for this sort of first time penalty abatement was to help people who maybe made a mistake but previously had a good compliance history. And she did have a good compliance history for the previous years. I mean, even this failure to pay penalty was only incurred because she voluntarily amended her return to increase the taxes owed. And I told the taxpayer when we filed this request that I didn't know how it was going to go because technically she did not qualify for a first time abatement. But to our surprise and delight, the IRS granted it. She had actually already paid it, right? So she had already paid the $80,000, and the IRS sent her a check back for $80,000 that she was able to deposit in her bank account. So that was a really great victory and a case that maybe some other people wouldn't have bothered to try. But with the penalty being so substantial, we thought it was worthwhile to at least give it a crack. Now, let's say you don't have a good compliance history, right? And you don't really have a 3-year period where you didn't incur a failure to file or a failure to pay penalty. There is another way to get penalty relief. In order to do this, you have to demonstrate reasonable cause. So that is sort of the threshold that you have to prove in order to convince the IRS to waive the penalties. What I don't like about this sort of rule is it's basically a gray area, right? At the end of the day, it's a judgment call by the IRS employees who are reviewing the request. And there's different guidance that they put out there outlining what demonstrates reasonable cause. Most recently, we had a case where a family had just gone through a number of tragedies. They had really horrible things happen over several years. And because of that, they filed and paid their taxes late. Now, these were very high income earners. They made between $500,000 and $1 million each and every year. So the penalties were astronomical. The good thing about a penalty abatement is it doesn't matter how much money you make, right? They don't look at your financial situation and say, can they pay this penalty or can't they pay it? It's strictly based on reasonable cause. Like, did you have a good enough reason not to file and pay your taxes on time? And in this particular case, because of all of the horrible things that were sort of going on, the IRS agreed to waive the penalty, which saved them hundreds of thousands of dollars. They still had to pay the tax that they owed. They still had to pay the interest on that tax. But all of the penalties and all of the interest on those penalties were removed. So again, it was a great result. You need to demonstrate that there was a very good reason for not paying or filing on time. And that reason, by the way, can't be I didn't have the money. That's not a good enough reason. It can't be my accountant just didn't file it on time. You know, you are ultimately responsible for making sure that your tax return gets filed. And it's not really a great argument just to throw your accountant under the bus. You have to demonstrate something more than that. So in that situation, it was a serious illness. In other cases, it's been maybe some mental health issues. It could be an issue with a fire, right? Destroying records or something like that. Those are typically the reasons that the IRS, say is good enough to waive the penalties. The third strategy I want to talk about is the offer and compromise. And this is the method that you've probably seen on TV. You've probably heard a radio ad for, where you can sell your tax set for pennies on the dollar. And yes, that is possible, but we'll say it's not probable, right? Not everyone will qualify for an offer and compromise. People who owe tax debt come to my office and they explicitly ask us to settle with the IRS. And I would love to tell every single client who comes to us that we can do that for them successfully. But I just can't honestly or truthfully do that. And it drives me crazy that there are other companies out there who literally, no matter what their situation is, no matter how certain they are that the offer would eventually be denied? How do you actually qualify for an offer in compromise? At the end of the day, it is basically just a math formula. The IRS is calculating how much money they would get if you paid them on an installment agreement until the statute expires, plus how much money they could get from any assets that you have. So let's say you own a home with equity in it, or you have retirement accounts, and they'll look at that number. So let's say they think they can collect $50,000 from you on an installment agreement, and you have $100,000 of equity in all of your assets. That's $150,000. And you only owe the IRS $100,000. Well, in that case, they're not going to settle with you because you have more money in assets and in future income potential than you owe. And the IRS has no incentive to take a settlement because in their mind, they'll get paid in full. Now, it's not a perfect line of reasoning by the IRS because there are situations where maybe you own your home and you do have a couple $100,000 of equity in it, but you can't access it, right? You don't qualify. You can't pull money out of your house and pay it over to the IRS. No bank will loan you any additional money. So that money, that equity is trapped. The IRS doesn't care. They don't care whether you can access the money. They just want to see if the money is there to potentially get one day. Because in their mind, well, maybe in 8 years they sell the home and then we can get paid then, right? Or maybe in 8 years their credit has improved and they could get a loan then. So they take a very strict view of this where even if you can't touch the money right now, maybe you can in the future. And that will factor into whether or not they will settle with you. So in cases where you can do a settlement, where you can be successful in doing an offer at compromise, you have to demonstrate to them that the money they get now is the same or better than the money they would get over time. So, for example, let's say you had a business and the business accrued a substantial amount of debt and you owe $500,000 in back taxes. The business went bust. It's no longer in existence. You decided not to start a new business, and instead you took a W-2 job making $50,000 doing whatever you're doing. You don't have any assets. Making $50,000 a year, it's going to be pretty hard just to pay for your basic necessities, right? You're going to have a rent that's going to cost you probably a couple $1,000s a month. Maybe you have a car payment that costs a few $100s a month. You're going to have health insurance costs. You're going to have out-of-pocket healthcare costs. Maybe you owe money to a state as well. But at the end of the day, that $50,000 is going to get eaten up by just ordinary expenses, right? Nothing extravagant, just ordinary and necessary expenses that you need to live. And so there's not going to be any money left over to pay the IRS. And you don't have any assets that you can liquidate to pay them. And so the IRS will say, yes, you do owe us $500,000, but we see that you can't afford to pay us anything. And so we will just take a lump sum payment. Now, the way this works is it's not really a lump sum payment. I know sometimes clients come to us and they're like, hey, I can't pay this huge lump sum all at once. That's not really how it works. When you file an offer in compromise, you're only required to put 20% of whatever it is you're offering down. So let's say you offer them $1,000. You have to pay $200 with the offer, plus a $205 application fee. But basically, you have to pay 20% of whatever it is you're offering. Now, because it's the IRS, it takes them forever to do anything. And 6, 9, 12, maybe even 15 months later, the IRS will get back to you. If the offer is accepted, at that point, you'd have an additional 5 months to pay the remaining 80%. So in our example, he paid 20% down, or we filed the offer, that was $200. And then the offer was accepted. He had an additional 5 months to pay the remaining $800. So it's not really a lump sum, even though that's the language that they use. Now, keep in mind, if you want to do an offer in compromise, you need to draw that line in the sand, right? So the IRS is more than willing to forgive the past due tax debt, but you can't continue to accrue new liabilities in the future. And the IRS will monitor this. I was just having a conversation with someone yesterday. Actually, we had done an offer in compromise for them. We couldn't remember. It was either back in 2018 or 2019. And he was asking, hey, is my 5-year period up? Like, I don't want to jinx it, right? But I know I have to go 5 years without accruing any new tax debt. And I don't plan on it in the future, but like, has it been 5 years yet? Because if you do accrue a new liability, so you file an offer in compromise, it's accepted, you pay it, the IRS forgives your debt. For the next 5 years, they're keeping a close eye on you. And if you file a tax return and you owe money and you don't pay, they will revoke the offer. And everything you owed in the first place, you now owe again, plus all of the additional penalties and interest that have accrued over the years. So if you're interested in doing an offer in compromise, it's really, really important that going forward, you have a game plan. And that's something that we help our clients with. Do you have enough withholding from your pay stub to cover your tax debt? If you're self-employed, what's a good strategy to make estimated tax payments? It's irresponsible just to do an offer in compromise for someone to resolve their past due tax debt, knowing that next year they're going to owe again and not be able to pay, and it's all for nothing. So you really have to make a plan not only to deal with the past due debt, but also to make sure that in the future, nothing additional is owed. If you learned something new today, go ahead and hit that subscribe button. It lets YouTube know that the content is helpful, and hopefully more people will find it. And if you need help settling your tax debt, click on the link below to book a free consultation with our office or review your situation, see if we're a good fit for you, see if you're a good fit for us, and hopefully help you figure out what the best method is to resolve your back taxes. If you're interested in more tax-related strategies, check out my next video where I'm going to break down the various different types of IRS installment agreements and help you decide what the best option is for you. It's really a game changer for anyone with serious tax issues. So hopefully stick around and check that video out as well.